All right, let's get into it. Today we're solving a bit of a Wall Street mystery featuring Hope Bank's Q4 earnings. The results look fantastic. The stock popped, but then it dropped. The question is, why? So check this out. On the day they announced earnings, the stock jumped over 3%. I mean, investors were obviously thrilled. But then, the very next day, the market did a complete 180, wiping out all those gains and then some. It's almost a perfect, spooky mirror image. So, this is the big question, right? How does a company put up what looks like a stellar quarter, get that great initial pop, and then see it all just crumble 24 hours later? That's exactly what we're going to unpack here. Okay, so to really get to the bottom of that drop, we first have to understand the pop. That initial jump wasn't just random excitement. It was fueled by some genuinely impressive numbers and a very, very confident management team. Let's break down the bull case. First up, the big headline number. Net income for the fourth quarter shot up a massive 42% year over year. That's the kind of growth that makes investors sit up and take notice, and it immediately signals a really strong quarter of operations. And here's another really key point. For a bank, it's not just about what you earn, it's about the quality of the loans on your books. Well, their criticized loans, those are the ones management is watching like a hawk. We're down 22% from last year. That's a huge improvement in asset quality. And look, the CEO, Kevin Kim, he set the tone right from the get-go. His opening remarks were confident, they were direct, and they really hammered home that strong bottom-line performance. He basically framed the whole year as a big success. And management didn't just talk the talk. They backed that confidence up with cash. They brought back their share buyback program with $35 million left to go. This is a classic signal to the market that says, hey, we think our stock is a great deal and we're putting our money where our mouth is. But here's where it gets really interesting. The good news wasn't just about how 2025 ended. The guidance they gave for 2026 was, you could argue, even more exciting. It painted this picture of growth just hitting the accelerator. Just take a look at these numbers from their guide. They're calling for 15 to 20% revenue growth. And even better, pre-provision net revenue, which is really a core measure of a bank's profitability, is expected to grow by 25 to 30%. That implies some serious margin expansion is on the way. So you're probably asking, how are they going to pull that off? Well, management pointed to two simple but super powerful dynamics on their balance sheet. First, you've got commercial real estate loans from 5 years ago maturing and getting repriced at today's much higher interest rates. And at the exact same time, you've got these high-cost CDs that are maturing and getting repriced lower. That's a beautiful 1-2 punch for their net interest margin. And the CEO just wrapped up the whole bull case with this statement, basically projecting a ton of excitement and saying they are perfectly positioned for the year ahead. So with all this good news, right, that initial 3% pop, it makes perfect sense, but it still doesn't explain the drop. All right, this is where we have to put on our detective hats and look a little closer. The reasons for that big reversal weren't sitting there in the headlines. Nope, they were hidden in the context, in the subtext of the earnings call, and in how the stock was behaving before the report even came out. Okay, clue number one. In the month leading up to earnings, Hope Bank's stock had already rocketed up over 8%. That's more than double its peers in the regional bank index. This created a classic buy the rumor, sell the news setup. The bar for a positive surprise was set incredibly high because the market had already baked in a lot of that good news. Now for clue number two, and this comes from comparing the short-term outlook to the long-term one. Management guided to this explosive 15 to 20% revenue growth for 2026, which is amazing, but they also mentioned that their normalized medium-term goal is closer to 10%. The market is a forward-looking machine, right? It might be looking right past that awesome 2026 and seeing a pretty big slowdown in growth on the horizon. And finally, management basically handed us this last piece of the puzzle themselves. While they expect to get more efficient, the CEO was very clear that reaching their ultimate profitability goal is a multi-year journey. For anyone hoping for a quick one-year turnaround, this was a clear signal to pump the brakes a little. Okay, so we've laid out the bull case, we've dug up the clues for why the rally faded. Let's put it all together, issue our official rating, and talk about what this all means for the stock from here. So to sum up this whole pop and drop mystery, the pop was absolutely real, and it was driven by a fantastic quarter and an even better guide. But the drop was all about context. The stock had already run hot, and a closer read of the call revealed that the incredible growth of 2026 probably isn't sustainable, and that path to peak efficiency is going to be more of a marathon than a sprint. So, with all that in mind, our official rating on Hope Bank is market perform. The company's got strong near-term fundamentals, no doubt about it, but the market seems to have correctly sniffed out that the medium-term upside is a bit capped, as that growth starts to normalize. After the pop and the drop, the valuation feels, well, pretty fair. Now for a trade idea. If you're on board with our market perform rating, what's a potential move? You could consider selling covered calls. Basically, this is a strategy where if you own the stock, you sell someone else the right to buy it from you at a higher price. You get to pocket the cash, the premium from selling that option, and you still participate in some of the upside. It's a way to generate a little extra income on the position if you're not expecting a massive rally. And of course, as always, we have to say it, this is not financial advice. Please be sure to do your own research before making any investment decisions.